I want to first say thank you. Thanks to everyone for joining this webinar. We're very excited to have all of you, and we're very excited to have our panelists and presenters today. As many of you know, Sustainable Energy for All and the SDG Goal 7 to achieve universal access to reliable, affordable, and modern energy, the goals of both of these are closely aligned. We at Sustainable Energy for All estimate that between 2010 and 2030, about $50 billion of investments will be needed annually to close the access gap, up from a current annual investment to around $9 billion. And this is largely needed in sub-Saharan Africa, South Asia, Southeast Asia, East Asia, and the Pacific. But more importantly, as you all know, finance is key to reaching this goal. At Sustainable Energy for All, we're focused on leveraging our own platform and our partners to ensure access to finance is available for all projects that help support these goals and to scale up these sources of finance. We are supporting countries, developers, and financiers across the spectrum to deliver tangible investments which meet these goals. But what we know is that more needs to be done to fill the funding gaps, and in particular to address the critical barriers that exist that when addressed can help unlock financing for projects of all types, including those that are in the grid connected and more importantly, or very importantly, those in the off-grid sector. One of the most common barriers to these projects is foreign exchange risk, and we're happy to have some of our panelists here today to talk about that. This session will focus on managing and understanding currency risks, specifically in the off-grid sector. These risks are most commonly identified in financing projects in developing markets, not just in the power sector, but across many different kinds of investment. But in addition, the challenges for financing some of these projects in the off-grid space are often distinct from those that are utility scale or larger, including some of the challenges include the need for equity and the need to aggregate smaller projects for larger sources of finance. There's also clearly a need to have specific financing vehicles that can help address many of these barriers in one go in the off-grid space, including foreign exchange, aggregation, and equity challenges. So we're proud and happy to have you all here today. We hope to learn more from our panelists and presenters, true practitioners in this space. I'm very excited about the presentations, and I want to thank you all for joining. Before we get started, I'll turn it back to you, Vibhuti Jain from the Power Africa team for some brief remarks.
Thank you, Stacey. I would just like to echo thanks to everyone and to SE for All for joining us to discuss this important topic. As many of you are aware, Power Africa is a U.S. government-led energy access and energy generation initiative. On the energy access side, we have a goal of adding 60 million new home and business connections by 2030 in sub-Saharan Africa, and clearly this webinar is very relevant to achieving that ambitious target. I'd like to thank all of our panelists and to give the audience some housekeeping items to keep in mind. Each of the panelists will be giving a brief presentation, and then we will open the floor to questions. The format for asking questions is as follows. If you look at the bottom right corner of your screen, you will see a chat window. If you have any questions during the course of this afternoon, if you send a question, if you click on send to all participants and you type in your question, after each of the panelists have given a presentation, we will go through some of your questions and ask them of the respective panelists in random order. If you would like to direct your question to a specific panelist, please note so in your question when you pose it. And we hope that this is an informative afternoon. Or morning, depending on what time zone you're in. We expect the total length of this webinar to be about 90 minutes. Without further ado, I'd like to introduce Dirk Munch from Persistent Energy, which is a Power Africa partner, we are delighted to say. And Dirk, would you like to commence with your remarks? Thank you.
very much for this kind of introduction. I'm not sure, I'm not seeing my slides yet. Not sure if anyone else does. Here we go. Here we go. Excellent. So yeah, if we can move straight into the first slide, please. So thank you for having me. I will try over the next 10 minutes to address in a very simplified way one of the key questions that is raised over and over again whenever we discuss the issue of currency risk and currency risk mitigation, and that is the cost of hedging. So I've tried to put together a very simple way to look at this, and I try to leave you with a few very high-level but crucial points when you ever face the question, what actually is the cost of hedging? But first, let's take a quick step back and recap some of the points that I'm sure most of you are aware of already and that we have made in the past. Off-grid energy services companies, PAYGO companies as they're often called, or DESCOs, by definition of their business model, are currently creating large receivable positions on their balance sheets, i.e. they are expecting future payments from their increasingly large number of customers. Therefore, there are naturally long local currencies, i.e. that position gains in value as the local currency strengthens, and unfortunately it loses a lot of value as the local currency weakens. To give you an idea of the scale of that problem, by 2020 we expect to see about $2 billion per year of additional receivables being created. That's a relatively big number. Of course, you all know that emerging market currencies are very volatile and can lose large amounts of value very quickly. And last but not least, an important point to keep in mind also when analyzing the cost of hedging is there's actually only one way to mitigate a long currency position really, and that is to borrow in local currency. You can do that directly in cash form by taking out a loan, or you can do it through a swap. However, at the end of the day, you always borrow. Today's focus, however, is the cost of hedging. And so let's please move to the next slide. In order to address the cost of hedging, I have created a very simple example here. And again, if I lose you in the meantime, I think that the key points at the end will be clear. So let's just take a look at it and remember that, again, there's only one way to hedge a long currency exposure, and that is to borrow in local currency. And therefore, you could simplify this and say, well, the cost of hedging is really the relative cost of borrowing in local currency versus the cost of borrowing in hard currency, or for example, in US dollars. So in order to give you an idea, I've basically created here a chart or a table that shows you how you could do that, how you could compare the cost of borrowing in US dollars versus the cost of borrowing the same equivalent amount in local currency, and therefore how you could calculate the cost of hedge. In this specific example, we are comparing a US dollar loan at an interest rate of 10% with a local currency loan in a unnamed local currency at an interest rate of 19%. And basically what you do in order to establish the cost of that loan is you discount to the present all cash flows under these loan arrangements in each currency. And when you do that, for example, you get for the US dollar loan a present value or cost of $15.53 if you take out a $100 loan at a 10% interest rate, while at the same time doing that in a market where the benchmark interest rate over 2 years is 2%. If you look at the local currency loan, what you find is that at an interest rate of 19%, on the equivalent amount of local currency would be, given that the exchange rate here in this example is 5, would be 500 local currency units, would cost you in local currency about 78 and 10 cents. And if you then, this is a present value, of course, and therefore you can use the spot rate to translate this into a US dollar value, you actually find that a local currency loan at an interest rate of 19% costs you $15.62. And now coming back to this very fundamental idea that the cost of hedging is the difference, or the difference in cost of borrowing in one currency versus the other, calculating the difference, you find the difference between those two costs to be about 9 cents. So for this simplified example, the cost of hedging is 9 cents per $100. Next, can we go to the next slide, please? So obviously I'm going through this fairly quickly, but what are the key points that if I only leave you with those, I would be happy or satisfied? First, again, to borrow is the only way to mitigate long currency exposure. And then second, the cost of hedging is the difference of borrowing in US dollars and the cost of borrowing in the equivalent amount in local currency. And in order to establish that difference, you basically calculate the present values of all cash flows under the loan arrangement in each currency and then compare them. And let me make two additional comments that are relevant here. And even if there's a lot of theory and kind of knowledge and expertise behind them, it's already a good point when you take, if you were able to take those points away. First of all, a high interest rate is not reflective of a higher cost of a loan. I've seen this many times, that people come and say the cost of hedging is just prohibitively high. And then they say that, for example, a Ghana cedi loan would cost 35% interest rate in local currency. But if you were to apply that same math and the same kind of approach, you would find that a Ghana cedi loan at 35% may actually be much cheaper than a dollar loan at 10%. So a high interest rate is not reflective of a higher cost. And most generally, and in most cases, what you actually expect is that the cost of hedging is zero, i.e. markets, unless they are illiquid or inefficient, which they always are to some extent, but basically you would expect that the cost of hedging is quite close to zero. This is also unexpected because everyone always explains about the cost of hedging. But that is a very important point to take away. Most of the times when you do this analysis and you do it in various days over a prolonged period of time, you will find that on average, the cost of hedging is actually really low. With that, let's just move to the next slide. And I just want to quickly just highlight what we think are the key elements. No, actually the slide before, please. What we think are the key building blocks of a currency risk management strategy, and keeping in mind what we've just discussed about the cost of hedging. First of all, I think investors and companies should be in a position to track their FX exposure on a rolling basis. At any point in time, any CFO of any frontier market business should basically be able to communicate to their shareholders what is the current FX exposure of the company. Given that most of the companies we are actually looking at will be long local currency, I think the key component of a risk mitigation strategy would be to develop the ability to borrow in local currency. Third, and this is what we've tried to initiate with this presentation, is to build the capacity to calculate the cost of hedging on an ongoing basis. And then last but not least, obviously, to set currency risk and mitigation cost limits within the company. And with that, I think if companies, and their investors would have those elements in place, I think we would be in a very good position to deal with the currency risk that we are facing by definition when we make cross-currency investments into frontier markets. Last but not least, if we can move to the next slide. We at Persistent Energy Capital have written extensively about the issue of currency risk and mitigation. You can find a quite detailed report that also goes into the exercise that we have just gone through. You can find that on our website. We have previously participated in webinars, and I'm sure you can find those links online as well. And we offer advisory services when it comes to FX risk to companies and investors alike. So I hope you found this useful, and I look forward to your questions. Thank you very much.
Thank you, Dirk. And just a reminder again, if you have any questions for the speakers as they're speaking, please feel free to submit them using the chat function under Send to All Participants. That's a bit easier for us than the Q&A function. And also, I'd like to point out that this webinar is being recorded. So for those of you who have colleagues that were not able to attend, there will be an option to view the webinar after it takes place. And with that, I would like to introduce our next speaker, Brian Cox, who is the President and CEO of MFX Solutions, a specialized currency hedging facility for development finance. Brian, over to you.
Thanks, Adubi. Okay, great. Just got my slides on. Well, thanks, and it's actually it's a pleasure to follow Dirk because he does a great job of simply, laying out the case for hedging. And I know we can have more questions about that, but what I want to talk about is if you are convinced by Dirk's arguments, how do you actually go about either hedging as a DESCO or accessing international financing in local currency? So I want to give a little bit of background about MFX first. MFX has been around for about 8 years, and we are really the only currency hedging facility dedicated just for impact investment. Through most of our history, we've dealt primarily with microfinance and SME financing, but in the last couple of years, we've expanded that to cover a broader range of impact investing, and really most notably in that new batch is renewable energy. So we have a lot of experience with the problem that Dirk just described, which is companies with local currency financing that need to borrow externally and need to avoid that currency mismatch that can be such a huge burden on their balance sheet. So MFX is a market intermediary. So we're essentially set up to make accessing different hedging providers, banks, and particularly TCX, which is an exotic currency hedging facility, which probably a number of you have heard of, but to make hedging easier for impact investors. And that means for impact funds, for borrowers in the impact sector, and that would include, obviously, the DESCO sector. The two ways we really make hedging easier is, one, by being able to provide hedging in really any currency. And the challenge in a lot of Africa is that a lot of African currencies tend to be illiquid, especially on slightly longer tenors, like above 1 or 2 years. And so there isn't really a commercial market for hedging. TCX is a specialized fund that does exotic currency hedging, and they can offer, and I can talk more about how their model works to be able to offer hedging in all these markets. But they are they basically open up hedging in really the full range of African currencies and illiquid currencies around the world. And MFX, as an investor and partner of TCX, is able to access that. And then we also intermediate between with a number of international banks so that we can access the hedging resources kind of across the market and bring them to the impact sector. The other big thing that we offer is we intermediate collateral. And I'll talk about that a little bit more on the next slide. But collateral is when you go into a hedging relationship, you're essentially creating a credit risk because you're going into a contract that implies payments in the future. And the normal way to deal with that, if you go and hedge with a bank, is you're going to have to put up collateral, put up money into a margin account at the start of the contract. And then as the value of the contract changes, you may have to put up more. So it creates a really big liquidity drain for a fund or for a borrower who's trying to hedge their risk. And I'll talk a little bit about how we do that. Just our track record, we've hedged actually now closer to about a billion, almost getting close to $1.5 billion of loans for impact investors. And we're, the demand, especially as we get into the renewable sector, is growing fast. So we are able to, to offer hedging as this market grows. Can I get the next slide, please? This sort of shows a flow of risk through the system, and this I think gives a sense of how how collateral works and how MFX fits into the overall system for dealing with currency risk. So if you're a DESCO, you have business risk, which is the risk you want to be taking. Are you going to make money? Are you going to be able to compete? Are you going to be able to sell your products? But as Dirk pointed out, if you're borrowing in a different currency than what your revenues are, you're also taking currency risk. So you want to carry that business risk, but you want to pass that currency risk on. And the way you can do that is either find an international lender who will take that currency risk for you and essentially themselves hedge that risk, or do the hedge yourself. In either case, there is this credit risk being generated by that hedge contract. So MFX then faces the impact investor, and we take the credit risk, and then we send on the currency risk onto either TCX or to banks who have different ways of offsetting that risk, but they take care of it. And then that credit risk, we are offloading to government guarantors. So we have guarantees from OPIC and FMO, the Dutch Development Bank, that allow us that essentially cover the credit risk on our counterparties who are impact investors. And what that means is since we have those credit guarantees, we don't have to charge collateral to impact investors, and that makes for a much easier access to hedging with a lot less liquidity drain. So what I want to do next, can I have the next slide? I just want to go through a couple of different structures, because even though we have these guarantees, there are limitations on how they can work. So if you're a DESCO and thinking about how you're going to mitigate your currency risk, or if you're a fund thinking about lending to DESCOs who need local currency, it's important to kind of understand the structures that are available. So in this case, this would be a DESCO who's borrowing from a renewable energy fund. So for an example would be that we did recently Responsibilities Energy Access Fund wanted to make a loan to M-KOPA, and M-KOPA needed to borrow that in Kenyan shillings. So the Energy Access Fund is a client of MFX. We signed a hedging contract with them. Because they're a fund, from a credit standpoint, they fit well into our model. Because they're diversified and they have a portfolio of impact investments that are supported by our guarantees, so we can hedge with them, and they can offer they were able to offer the local currency to the DESCO to M-KOPA. So that's a very simple one for the DESCO. It's just borrowing in local currency, and that should really be for DESCOs. That should be the first approach, is to go out and, even if you're borrowing externally, try and push your lenders to lend to you in local currency and take the hedging burden themselves. If we can go to the next slide. So the next structure is if a DESCO is getting a loan from OPIC, and this structure can work with other DFIs. Since we already deal with OPIC, it works quite easily. It's quite easy for us. And here, OPIC and some other DFIs only lend in hard currency. Will only lend to you in dollars. So you don't then have the choice of borrowing in local currency if you're the DESCO. However, OPIC provides this credit guarantee to MFX, and for its own clients, we don't normally like in the previous example, if we were to have a default and use our guarantee, we would have a debt and we'd have to repay that. So we do care about the credit risk and want to work with funds that are creditworthy. In this case, though, OPIC gives us a blanket guarantee for their own customers, so the DESCO can hedge, and we wouldn't charge any collateral, and we would be able to take that credit. And instead of the burden of hedging falls on the DESCO, but it essentially, from an economic standpoint, is just borrowing in local currency, with the swap just covering the currency risk. So you have two transactions instead of one, but it's the same as hedging, as borrowing in local currency. Right, can we go to the next slide? And the last structure is really kind of a hybrid of these. If you're borrowing from a commercial lender who isn't able to offer local currency, in the first case, you can encourage them. You can send them to us. You can encourage them to hedge with the bank if they have that option. But they are going to your lender is probably going to be a better credit than you as a DESCO. If they can't, they can provide a guarantee. Often we can work with seniority in the loan. At worst, we can ask for collateral from the DESCO, although that loses a lot of the liquidity advantage. So there are ways to figure out structures even if we don't have either a DFI lender or a fund, but it takes a little bit more. It takes a little bit more doing. If we can go to the last slide. A question we get a lot, so I thought I'd answer it first, is why should we go through an intermediary? Aren't there costs? Why can't we just hedge directly with a bank or directly with TCX? On the question with TCX, TCX can in some cases hedge directly with usually local banks, but they can hedge directly with clients. But they do require collateral, and also the pricing that you would get from them should be roughly the same as the pricing you would get from us. We do charge a 50 basis point spread, but because we're investors in TCX, we get a lower price, so it comes out about even. So there's no real advantage to going through TCX, and you do get the advantage of not having to pay collateral through MFX. Similarly, with banks, you're often going to be required to put up collateral generally, unless you've got some significant relationship with the bank. and you know, MFX rates should be around the same. The only difference would be if there's local bank options, and in Africa those tend to be shorter term, but that, you know, local banks can be a good alternative if you can develop those relationships. So so I'll stop there, but happy to talk more about the kind of practicalities of hedging.
Thank you, Brian. That was very informative. Just a reminder to everyone and a clarification, if you would like to ask questions, there's two ways you can ask them. You can either go to your chat function and send to all panelists, and we will be doing a Q&A after each of the speakers, or you can go to the Q&A tab and submit a question that way. It's whatever is easiest for you. I think we have a slight preference for the chat, but just do what makes the most sense to you. I would now like to introduce our third speaker, James Dorey, who's a director at Lion's Head Global Partners, and he's going to be speaking about his work with the African Local Currency Bond Fund. Over to you, James.
And then do let me know if there are any problems hearing me. Just to build on what Brian was talking about, as a fund that manages quite a large swap portfolio, I can re-emphasize the value of having uncollateralized hedges and swaps in terms of managing, in terms of your risk management and the practical advantages that it gives you. I mean, when we talk about the African Local Currency Bond Fund, I want to talk about domestic funding in quite broadly. But let me start with introducing who we are. Lion's Head is an investment and advisory firm. Our advisory work involves across the renewable energy space, working with developers, companies, and DFIs in both the on-grid and the off-grid sectors. I think given the theme of the discussion so far and the slides that I prepared, the focus here is on certainly on distributed solar and renewables, particularly at the household level, and the implications for asset-backed lending and receivables financing, as opposed to industrial and utility scale renewables, which is a different subject matter, but one in which we're involved as well. African Local Currency Bond Fund was set up about 3 years ago by KfW, primarily out of their work in the financial inclusion sector. A lot of the logic flows from the idea that as NFIs and other institutions reach scale and maturity and develop a track record, they should be accessing capital markets as a means to access domestic funding. There's increasing and growing liquidity in African markets in particular, and there is a lack of primary issuance. There's various bottlenecks in these markets. So the fund was set up with a mandate to support issuers at an early stage, provide technical assistance for legal support, and to mitigate some of the transaction costs involved, and to then act as an anchor investor in the bond issuance. So if we just flip to slide 2, and here we just present the sort of overall aims and impact of the fund. It's about developing local capital markets. It's about improving risk management in clients' balance sheets, and it's about channeling capital into high developmental sectors like financial inclusion, housing, agriculture, and of course renewable energy. We do that not just through, it's important to emphasize that we do that not just through listed bonds, but also private placements and in some cases syndications. Our key requirement is that there is domestic participation in an issuance. So if we skip to number 3, I mean, not to dwell too much on the benefits of domestic market funding. So I think it's important to distinguish between, on the one hand, borrowing local currency and managing or transforming foreign currency borrowing into local currency borrowing through risk management instruments, and accessing the domestic market directly. And so the case, the latter over and above the former, there's a cost case, but there's also, I think the strongest case is that the domestic market is the most sustainable long-term source of funding for companies and financial institutions. in the medium to long term, right? Those investors will always be there. They'll never be eclipsed by whatever the latest fad is amongst certain sort of offshore investors. And it's a sign of, I suppose, development in that sector. What I want to do now is just on slide 4. It's just quite a simple schematic, emphasizing the point that a capital market is just a means of channeling domestic savings back into the real economy through a series of institutions and instruments that present recognized and transparent instruments to investors, and it's at the highest level. So how is this relevant to the sector that we're talking about, to off-grid energy? What I would do, I think, is skip to slide 9. The intervening slides are more about the fund. So this re-emphasizes the point. It's somewhat underreported, the growth in liquidity in the investor base and investor sophistication in most African markets. But this is a slide provided by Standard Bank that shows the top institutional investors in selected markets, the scale of industry and pension assets under management, as a sort of exposition of the core opportunity. The challenge is, of course, how do we create structures that are suitable for those investors. So on page 10. So here we present a very high-level schematic for how asset-backed finance works in the most straightforward form. And this doesn't have to be outright securitization. It can be receivables refinancing or pledge of collateral. There are various means to do it, but effectively it involves a symbiosis between the bank and the capital market. So you have let's call the issuer here Adesco. They have customers through which they originate a loan that may or may not be secured, but in most instances in our sector would ideally be secured. They then fund that loan by drawing on a warehouse facility with a domestic bank. Once a scale has been built up in that pool of loans, the bank is repaid by issuing or pledging that collateral either through an SPV or directly just through the issuer, through a capital market structure like a bond or like a private placement, but where investors have access to that collateral pool. So the bank facility allows you to build scale. The bond structure allows you to have access to long-term finance and to create an instrument that's suitable for domestic investors. So if that's the sort of typical ABS or MBS type structure in many emerging markets and even in several African markets, the question or the challenge is how we get there and what are the alternatives in the immediate term. So as I stated earlier, the ALCB fund can participate in private placements or listed bonds, and in certain circumstances may also consider bank loans. The purpose of a fully listed bond is it's the most, I suppose, institutionalized form or institutionalized structure that gives you access to the broadest set of investors. It potentially has higher transaction costs and requires greater scale. So for pilot transactions, it may make more sense for a private placement to be the immediate form of accessing investors. Now, this limits the pool of investors that you can tap, but nonetheless doesn't require the full regulatory process of a listed bond. Now, of course, a direct bank loan or a syndicated bank loan is certainly an alternative, and as we see on the next slide, this is something that's certainly a development that's been noticed over the last year or so. So I would argue that when we started conversations from the perspective of the ALCB fund with a lot of the off-grid companies. Currency risk was fairly low on the agenda, and I think for anyone that, I mean, I wasn't there myself, my colleagues were there, but anyone that was at the conference, the solar conference at the beginning of November in Nairobi, I mean, from what I understand, it was the dominant theme of the event, and then continues to gain prominence, as you, I suppose, most obviously through this webinar and others like it. So as that awareness has increased, I think you've seen other developments, right? So as Brian described, but also as TCX has been working on, there's an increasing appetite for the sector from those entities. As Dirk maybe coyly didn't mention, they have themselves worked on a securitization deal for BBOX in Kenya. And there's certainly increased interest in the use of credit enhancement for the likes of Garanto or even USAID themselves in their DCA product. I think the bigger story that's not really come up yet, and but certainly over the last 6 months has taken off, is the interest and role of regional and domestic banks. So for example, someone like Standard Bank working with at least 3 of the larger players in the sector. They're actually working on a rather large syndication right now, which involves local currency financing. Obviously, Standard Bank is able to provide funding through its Stanbic Kenya balance sheet, but also able to provide swap services itself, or hedging services, so it's able to provide its client in that case with shillings. And in other cases, albeit at a smaller scale, we see a Kenyan bank or even a Rwandese bank engaging with the sector on a small bilateral loan basis, or in one case even through this sort of warehousing facility that I described earlier. So I mean, this is a lot of change in a short space of time, and I suppose the danger is that, you know, we sit around talking about structures that are already overtaken by developments in the market. From ALCB Fund's perspective, and I'll just make this last point, we still are working with banks and with companies in the space to promote the structure discussed on the previous slide, to encourage banks to develop warehouse financing facilities, to provide technical assistance for credit ratings and legal support. We're also in discussions at various stages of progression around transactions in Rwanda, Uganda, and Kenya. I think one of the final thoughts I'd leave you with is that I think it was well through our technical assistance facility, we're keen for ideas and initiatives that can help take the space forward and increase awareness and systems that can process the sector for domestic investors. So I think maybe overrun there, but I'll pass it back to Vibuti.
Thank you very much, James. We appreciate it. And that was a really great presentation. So we have one final speaker for you all, and that is Fernando Valderrama, a Senior Investment Officer at the African Development Bank. And Fernando is going to speak to some of AFDB's work in the off-grid sector and about an exciting new facility that the bank is launching. And after Fernando speaks, we will have a Q&A session. We do have some questions from the audience, and if we, and we also have some questions that we the moderators have prepared, but we would like this to be useful for all of you. So if there's anything you would like to ask our experts, please don't be shy and send through your questions. Thanks. And over to you, Fernando.
Thank you, Vibuti, and thank you to Power Africa and Seed4All for organizing this webinar. I'd just like to talk a little bit about what the African Development Bank is doing when it comes to local currency and the energy sector. If we can go to the next slide, please. Let me just say something about our team, and there are a few lines there that just need to come in. Sorry, Vibuti, I should warn you about this. if you just click on the slide, yeah, there you go. So the private sector department, we're the infrastructure division. We have about 15 investment officers, and we focus on energy, transport, water and sanitation, and ICT. Most of what we do is energy, and of course, with the new deal on energy now, this is that the bank is proposing now. This is a key sector for us to focus on. Please, the next slide. Yeah, sorry, one more. Here we go. So in terms of the local currency risk and the efforts that the AFDB has put forth, you know, a lot of you know, of course, some of the work that the bank is doing. James, the person I was talking about, MFX. We do local currency lending. We have 11 different currencies that we're able to provide senior and mezzanine financing on. We were, of course, also part of the equity investors into TCX in 2007. We approved an equity investment of $25 million into TCX. We've been exploring project bonds, and we've held a number of discussions on project bonds with Power Africa and many of you, and we are excited sort of like to see more being done on this side of things. The AFDB has partial guarantees. We have partial credit guarantees and partial risk guarantees. These are very, very flexible instruments that can actually go into addressing local currency risk, and that's something that we are quite keen and excited to continue to innovate as we go forward. Our financial intermediation department, they do lines of credit in local currencies. And we're very active with most financial institutions on the continent. But very recently, we've been sort of like looking at how to address this from within our shop, from within infrastructure finance, this local currency issue. And essentially with, you know, two things that we're doing is, and I won't talk much about the off-grid solar provider that we're currently sort of like considering to finance. This is in East Africa. It will be a local currency facility. But what I really want to talk about is the facility for energy inclusion. The facility for energy inclusion, if we can go to the next slide, is essentially a $500 million debt fund that seeks to provide senior and mezzanine debt financing to small-scale renewable energy projects. Sorry, if we can go to the next slide, please. So yes, so essentially, this debt fund is there to provide senior and mezzanine debt financing to small-scale renewable energy projects. Those projects are $30 million and less in total project cost. We're essentially going after those projects that are currently not being able to tap into either commercial bank financing or DFI financing because the transaction costs associated with undertaking due diligence and appraisal processes for these projects is too expensive and the economics of the project don't work. So we're designing a special facility that will be providing debt solutions to these projects. And one very important aspect of FEI is, of course, the local currency tranche, right? As I mentioned earlier, the African Development Bank is able to provide financing in local currency, and so we'd be looking at structuring our investment into the fund, partially at least, in local currency. This is something that is very, very current. We're going to our board of directors with FEI on Monday with a proposed investment of up to $100 million. And again, this is something that seeks to deploy international best practices. This is a closed-ended fund that will be externally managed. And so far, we have run a tender process, and we have shortlisted 6 different fund managers that may be working with the bank and other co-investors to bring this fund forward. If we can go to the next slide, please. Sorry, one more. Yeah, so in terms of the local currency aspects of the fund is going to have ordinary shares, and then it's going to have two types of specialty shares. There are the S shares that are going to be looking specifically at that sort of like mezzanine tranche that carries slightly higher risk in the fund, and that will be catalyzing slightly riskier projects and in riskier jurisdictions. And then there is the L shares. And the L shares will enable certain investors to come in alongside African Development Bank and invest specifically in local currency financing. We are currently working very closely with Dalberg, who is a structuring agent on this facility, to sort of like just understand and structure the best way for us to welcome this investment by co-investors into the fund. Are these going to be sort of like, is this going to be a special pocket of money that will only sort of like focus on local currency financing, or is this going to be something where we have a capital pool that is able to focus on certain aspects according to the risk profile of the operation? It's something that we are still structuring, and like I said, we are running that fund management tender, and it's something that we hope to finalize within the next few weeks. The idea, of course, is that since we're able to provide local currency financing, we can do a match funding, right? There are certain projects out there that are relatively more ready than others. There are certain countries that are relatively more ready than others for, say, off-grid and mini-grids. There is, of course, East Africa. There is Kenya, Uganda, Tanzania. And there is in West Africa, I'd say that Nigeria and Ghana are ahead of the curve. So we'd be looking at potentially channeling part of that, of our liquidity, in some of those local currencies, wherever the projects are readily available. And then with time, sort of like going and seeing what additional liquidity we need. But of course, this is not something that is going to be possible to do without some hedging, and that's where MFX and TSX and the likes come in. Essentially, we'll be looking at hedging solutions that allow us to keep 6 to 8% interest per annum still on the loan after the hedging cost. So we know that hedging varies from jurisdiction to jurisdiction. And say in East Africa, costs are between 10 and 13%, significantly higher in Nigeria, 17, 18%. But of course, we have something very interesting happen in Francophone West Africa, whereby these currencies are relatively stable and they are pegged to the euro. For these currencies, the facility will essentially be running trade between euros and dollars, and sort of like balancing and optimizing in that manner to ensure that we are able to provide local currency solutions, which of course, for those very reasons, are in relatively lower demand in those jurisdictions. So the facility is Pan-African in nature, and that brings significant diversification effect. The correlations between currencies in particular regions in Africa, in East Africa, in West Africa, they can be between 80 and 90%. But when you take the continent as a whole, those correlations between currencies go down to, say, 50, 60%, and that allows us to potentially run some open positions, which is something that will be very interesting to the facility as well, and that will ultimately sort of like be passed on to the beneficiaries. Next slide, please. So just a word on the New Deal on energy, and I'm wrapping up now because I know that I'm running out of time. The New Deal on energy seeks to increase on-grid generation by 160 gigawatts by 2025. The vision of the African Development Bank here is to attain universal access to energy in the continent by that year. And this basically requires, in addition to that new generation, it requires 75 million off-grid connections, right? And that's why sort of like off-grid and mini-grid solutions are so important. And it requires strategic partnerships and working through all of the partners to really get there. The Facility for Energy Inclusion is just one of the many initiatives that the AFDB is currently putting out there, and something that is very exciting, and we hope that many of you will be joining us there. Thank you, Vibhuti, and I'm open for questions.
Thank you, Fernando, and thank you to all of our panelists. So for the next approximately 20 to 25 minutes, we will go through some of the questions that we've received from the audience, and then we'll provide some closing remarks. Just a reminder, this will be recorded, and you will be able to access all of the panelists' presentations. In addition, Dirk mentioned some further resources relevant to his presentation for those who have interest in learning more. So, turning to back to our panelists, I would like to pose a question that I think several of you may want to comment on, including Dirk and James. The first question we have is, if the cost of hedging local currency exposure is near zero, as stated by Dirk in his presentation, and institutions like MFX and TCX are able to hedge most sub-Saharan African currencies, why are DESCOs not hedging this local currency exposure more regularly? Second part of this question is, James mentioned, actually, well, that's a separate question. So yeah, let's take it from there. And Dirk, if you want to start, perhaps Brian will want to add something in as well.
Yeah, thank you. I think that's an excellent question, and frankly, I don't know the answer. There are several things that might be the answer. One is the fact that the cost of hedging is close to zero is the theory, and in practice it may differ from that. But I would be surprised if many of those who say it's too expensive actually can really quantify just how expensive it is. And even if it is expensive, the question then still remains, is it worth buying the insurance, i.e. hedging, given the size of the risk? I also think that what you clearly are seeing at the moment is that more and more companies are actively trying to mitigate their currency risk, not necessarily through trading with MFX or TCX, but rather by going the direct route, which is something I also recommend, and borrow in local currency. And you have seen transactions now in East and West Africa of DESCOs borrowing in local currency. And I would expect that in particular as exposures grow, they will revert more and more to that.
Yeah, I think when we've talked with DESCOs about if their interest in hedging, just a concrete example. We're talking to a DESCO in Nigeria, and this was a little while ago before the really big devaluations, and they were looking at the rates that they were pretty high. They'd gone up, so the interest rate differential between dollar rates and naira rates, and that's essentially your hedging cost, were pretty high, and they didn't hedge, and there was obviously then they faced that devaluation. So we went back and talked to them afterwards, and what their reaction was, well, we just raised our prices. And so, if we did lose, but we were able to adjust to it, and if we hedge now, maybe the same thing wouldn't happen again, and we would lose again. So I think part of it is sort of a mentality of looking at each hedging decision in sort of a microcosm, and as a bet. And what we tell our clients, and we have a lot of experience, I mean, in microfinance has gone through this whole sort of, kind of mental evolution over the last 10 years. where you have to think about it as, you know, as just shifting the way you do business. And you can't think about it as a single transaction. You have to think about it as, okay, we're going to start operating in, we're a local currency business, and we're going to start operating in local currency. And I think the problem is, if you measure it on whether you win or lose on each particular hedging decision, then you're never going to want to sort of pay that price up front, which of course isn't really, if you think about it in the long term, isn't really a price, as I think James, as Dirk sort of described. But if you think of it out as a transaction, and you're saying, okay, I'm taking my potential losses up front, and I might come out ahead, I might come out behind, but I'm sort of always faced with a bet, each time. And I think it takes a while to readjust the thinking. But I think over time that does happen. I just had one thought while James was talking about kind of local currency financing. And we really saw this development in microfinance. That microfinance used to be much more funded externally, and then it sort of went through a process where there was kind of an interim process where there was more external financing that was coming in local currency. But then it moved more towards local financing in local currency, because ultimately that is the cheapest. And now in microfinance, by far the largest amount of financing is coming from local markets. So I think that will be a development that we see in the renewable energy sector too.
Great, thank you both. So along those lines, my next question is for Fernando. Fernando, when you were describing the Facility for Energy Inclusion, and in previous discussions that Power Africa has also had with AFDB on it, we've discussed quite in depth how the facility will essentially directly lend as part of its financing structure. And since local commercial banks that do have local currency liquidity have not been very active in lending to the off-grid sector, if the AFDB is going to be directly lending under its Facility for Energy Inclusion, how do you think the Facility for Energy Inclusion will nonetheless help pave the way for local lending to the off-grid sector?
Thanks, Vibhuti. Look, I think first of all, I think it's important to recognize that there are a number of commercial banks out there that are starting to look at the sector, right? And that's very exciting. There is, the AFDB is currently working with one of them in East Africa that is sort of like acting as coordinator and liquidity provider as well. We were very, very happily surprised for an off-grid solar company. And I'm not at liberty to say which one, of course. But this is something that is exciting, and we'd like to see that more and more in the sector. Now, having said that, there are some debt facilities out there that are currently being structured that will be providing that will be focusing on providing lines of credit to financial intermediaries to then on-lend into the off-grid mini-grid space in the continent. But for FEI, the AFDB's intention is to tackle the problem yesterday. We need to go in. These companies are not able to achieve a significant scale because oftentimes they don't have, the significant liquidity available to them or the tenors that they need to be able to make this space work. So we are focused on that scale. Our New Deal on Energy is very ambitious, and we are really trying to come up with a solution that can immediately tackle the challenge. Having said that, it is of course very important for us to develop new financing models, right? To look at the intersection between project finance and receivable-based finance, so that we can readily develop financial products and services that can make a difference for the sector. And the idea is, of course, this is in many ways it's a DFI-led initiative perspective, the idea there will be to package those lessons learned and share them with the commercial banks, right? And that's something that comes to the core of the objectives of AFDB and what we want to do in terms of developing the financial sector in Africa. Thank you.
Thank you, Fernando. So our next question is going to be about securitization, and it's I have a few questions on this subject matter. The first one I'm going to address to James. So James, this question is for you. Many of the markets in which we're discussing, in which the African local currency bond operates, and which many of our audience members and speakers operate in, have highly illiquid public exchanges. Can you speak a little bit more to whether the corporate bond structure is therefore too complex, or whether at times it's perhaps not appropriate, and when it does make sense? And a follow-on question to that is, why focus on bonds as opposed to, for example, syndicated debt?
Thanks, Vivuti. I mean, so liquidity can mean one of two things, right? It can mean primary liquidity, i.e., the depth of the investor base, and secondly, it can mean liquidity or transaction volume, i.e., secondary market liquidity. And obviously, corporate bonds, even in South Africa, but across the African continent, are relatively illiquid, and the liquidity has an impact in relation to price discovery and the overall efficiency of the capital market. But nonetheless, a loan is an illiquid instrument as well, right? We're not talking about capital markets being at a disadvantage because there's a lack of secondary market liquidity relative to loans, because loans are illiquid instruments. I think one of the points I tried to make is that primary liquidity is actually growing, and the investor base is growing and becoming more sophisticated in terms of regulation and management in many markets. When it relates to securitization, you have a pretty variable sophistication of ABS frameworks, asset-backed securities frameworks, and securitization frameworks in various markets. I know that this has been an evolving question in Kenya for about 8 years now, and we've just gone through another cycle of consultation on their ABS laws. That's relevant only insofar as you're trying to do a fully listed bond. You can do a private placement through a structured finance model. It doesn't have to be a true sale securitization. What we've seen in Ghana, for example, we're working on a mortgage finance deal where there's a pledge of receivables through a collateral pool, not through a securitization, but it's effectively trying to credit enhance the structures to some extent, although it doesn't achieve the same sort of level of credit remoteness. To me, the big challenges around securitization are twofold. One is how much credibility does a servicing agent have, i.e. the agent that's responsible for making sure investors get paid if the parent defaults. So that's relevant for a truly credit remote securitization structure. And secondly, if there's not much experience of default in a lot of these markets, even in a vanilla corporate bond, the default would have a big ripple. I mean, you just have to look at the impact that Chase Banks had on the Kenyan market, or that African Bank had in South Africa a few years ago. So, once this market starts evolving, it can be subject to quite a significant shock from any default scenario. And to be honest, all the legal mechanisms, all of the documentation and the pledge of receivables, none of that will have been tested until there is a default. So it's not necessarily a panacea, but it is certainly a structure that has been used to great effect in related sectors. I think in relation to banks, loans versus bonds, I mean, there are other funds out there offering loans. You heard about Responsibilities Fund earlier. A lot of the Swiss fund managers have either dedicated or tangentially related funds that can lend to the off-grid space. For larger transactions, banks and development finance community are active. I mean, our focus is around developing the local capital market and giving institutional investors somewhere to put their money other than government bonds and real estate.
Great, thank you for that, James. So now I'd like to turn to a question that I think perhaps all of our panelists may want to comment on. We received 2 questions about the regulatory environment, and I'm going to read them both. And perhaps Brian, you can start off, and then whoever else would like to comment can also supplement the comments. So the first question is, I would like to understand what regulatory hurdles might arise regarding the issuance of local currency loans by funds that are not necessarily based in and perhaps require licenses or permits to operate in emerging markets. So again, that's a question about the regulatory hurdles that offshore funds might face. And then the second question is as follows. So Power Africa's utility scale developer partners sometimes seek regulatory relief, such as tariff indexation, regulatory carve-outs or exemptions, or central bank prioritization for foreign exchange availability in order to alleviate their currency risk management concerns. Are there comparable forms of regulatory or government relief that off-grid companies can seek? Can you speak more generally to the different ways foreign exchange risk impacts larger utility scale developers versus off-grid companies? So first question is just generally on offshore funds. The second question is on types of regulatory relief strategies that DESCOs can potentially pursue.
Yeah, I can certainly speak to the first one. Obviously, the regulations really vary by country in terms of what external lenders can do in terms of offering directly in local currency or whether they can only offer hard currency. But that actually doesn't necessarily affect from an economic standpoint whether they can lend in local currency. And this is something that a lot of our clients do in the microfinance space. Which is that they make synthetic local currency loans. The loan is in dollars, but essentially it's denominated in local currency. So when the loan is made, let's say you have $1 million loan. When the loan hits, basically the principal on the loan is set in local currency. And there's a local currency rate that's calculated on that principal. When the repayments happen, they essentially whatever the local currency interest plus amortization payment is valued at the spot rate on the day of payment, and that payment is made in dollars. So you can still have essentially dollar loans, but they can be local currency denominated. And then you can hedge those. Almost all of our hedges are non-deliverable, so they're offshore, settled in dollars. So they aren't really impacted by the local regulations. So you can operate totally in hard currency, but still achieve for the client a local currency loan. But in some markets, obviously, you can't. You can convert and offer local currency, which in some cases is a little bit more valuable because you can face if you can face a little bit of slippage between the rates that the local borrower can get from its local bank to convert to dollars and the rate that might be built into the loan. So you can have it's a little bit more attractive to do it in local currency directly, but that's not a huge difference.
Great. Does any of our other panelists want to speak to that or respond to the second question, which was asking about some more information on the types of regulatory or government relief that off-grid companies can seek, or different ways foreign exchange risk impacts the off-grid sector distinctly from the utility scale sector?
Well, this is James. I mean, just very briefly, obviously a lot of utility scale renewable energy is financed in principle by the DFIs and DFIs, like the African Development Bank, obviously have preferred credit status in the markets in which they operate, which includes access to the central bank for convertibility, currency convertibility in most instances. They also have things like AB loan structures to pass those benefits on to other lenders. So there's a whole raft of structures available in the utility scale space, which maybe haven't been thought through fully for the off-grid space. I mean, going back to Brian's example around microfinance, if you go to the big 4 or 5 microfinance banks in Nigeria, where convertibility is a real issue at the moment, they are really feeling the pain of not being able to source dollars, even though they hedged in the first place, right? So they entered into a non-deliverable forward, it settles in dollars, they can't get the dollars out of Nigeria. So other than those companies working with swap providers who can provide outright swaps or deliverable swaps that settle in local currency, I can't think of any sort of regulatory options. I mean, the Central Bank of Nigeria has actually recently created a 1-year futures market, which is quite strange and creative, but it involves a subsidized settlement FX rate, so that you have an incentive to bring dollars onshore because you're getting more dollars back at maturity in theory, but you've still got to then convert those naira because it settles in domestic currency. So I don't know whether there are creative structures like that in other markets, but certainly I think that it's kind of an underdeveloped space thinking about that conversion risk.
We were talking with the U.S. Exim Bank, and they had a client that actually used Bitcoin to get their naira out of the country to pay Exim Bank. So there was a lot of imaginative approaches going on.
I'm sorry, if I can say just something on the AB loan, which is, thank you, James. It is something that it's not well known out there in the market, but it is a way to address precisely that, right? Transferability and convertibility issues. Essentially, the African Development Bank acts as a lender of record that we turn around and we get up to 75% of the liquidity from commercial banks that are coming from outside of the jurisdiction where we are lending. And that way, we extend our preferred creditor status, our PCS, onto those commercial banks. We've recently done that in South Africa. This is a $1.4 billion transaction with Eskom. And although that transaction was not sort of like a local currency transaction, well, it was a bit of a hybrid because we have the A loan, the liquidity from the AFDB was in local currency, and then sort of like the commercial bank liquidity was in her currency. But in any case, that umbrella does provide for transferability and convertibility cover, as well as withholding tax exemption, right? So that's interesting.
Vituvi, was the last part of that question the difference of how currency risk affects DESCOs versus the utility sector?
Yes, it was.
Okay, so I think you can think about it with it, with a DESCO, as Dirk said, okay, DESCOs build up these big receivable positions, and if their liabilities are in dollars or euros, then, and they have a big devaluation, those receivables are worth a lot less in dollars and euros, so their effective cost of borrowing goes way up, and that can destroy their business, or then they can go out of business, and that's sort of the effect of the currency risk. In the utility sector, and this is very, this is basically the primary model is now, although you're seeing some evolution toward PPAs that are denominated in local currency, but you have a indexed, PPA and financing in dollars for the build out of the, if it's a big solar array or whatever. And there, basically, if there's a devaluation, the rate structure adjusts, and so either that rate structure is passed on to the utilities customers, and they essentially absorb the effect of the devaluation in their electricity rates, or the government has to come in and subsidize those rates to protect them from that movement, and so it falls on the government. So I think that that over the long term is kind of having PPAs be increasingly denominated in local currency. And then, then you have to deal with whether you can finance in dollars, because somebody has to take that risk. So then you get to having to figure out how to finance in local currency and hedging, et cetera. But that's still, I think predominantly that risk is now predominantly held by the ratepayers.
Thank you for that. Brian. So it looks like we're almost at time. I'm going to ask one last question, and this one was for Fernando about the AFDB's facility for economic inclusion, and that is, does the African Development Bank have any intention to reach out to other DFIs with respect to this facility?
Absolutely. Thank you, Vibhuti. And thank you for the opportunity to do a little bit of marketing here. Yes, the Facility for Energy Inclusion is in fact seeking co-investors to come in and join the AFDB's efforts on this. We will be undertaking a formal fundraising campaign just shortly after we obtain that board approval, hopefully this coming Monday, December 12th. And we are, of course, talking to various partners from within North America, yourselves included, Viv, Europe, and of course, Asia. We've had a number of sort of like informal discussions so far with various parties, and I don't want to give the names just yet, but we hope to formalize those discussions and formalize those relationships to make sure that we do reach a first financing close by the second quarter of 2017, and we render this facility operational by quarter 3. Sort of like just by being active in the market and really sort of like having done all these projects for the past few years, the number of requests that the AFDB has gotten from small-scale renewable energy projects, be that small IPPs, be that off-grid, is really significant and overwhelming. And of course, on most of these instances, we have not been able to operate because, for a DFI, you talk about a project that has sort of like $30 million and less in total project cost, and you are just automatically sort of like not able to really spend much resources on that particular project. And that's why we have been populating for the past couple of years a very rich pipeline of opportunities that we will then be sharing with the fund manager as soon as they are sort of like signed up for their own, of course, consideration and due diligence. But it's something that we think can definitely hit the ground running sort of like in mid to late 2017. Thank you.
Thank you, Fernando, and thank you to all of our panelists, and again to SE for All for coordinating this wonderful webinar this afternoon. We will make this available online, and we look forward to doing future webinars on different topics. This is the second one in the series. We did one earlier on currency risk generally for the power sector. This one focused specifically on off-grid. If any of you in the audience have suggestions for topics that you'd like to hear addressed, please don't hesitate to reach out to myself or my colleague Albert Osweke or to SE for All, and we'd love to hear your suggestions and comments. Stacy, over to you if you'd like to add anything else.
No, just to echo your thanks, Subhuti, to all of our panelists. This has been really informative, and I think we all learned a lot. Thanks for all of your time this morning and this afternoon, depending on where you are in the world. And we will make sure to have this information available if you would like to come back and look at any of the presentations. Thanks very much, everybody.